Are you ready?
Ready.
All right, let's go. Kevin here, Top 1 Financial Advisor and best-selling author. We are here to talk about the stock market. If you don't already know by now, the stock market is closed, which I don't think that is a shock to anyone. But days like today is a perfect day to relax, get on the grill, and get on the whiteboard on the YouTube channel. So this is my chance to kind of break down some things because I got a little bit more time than what I normally do. But today I want to break down 3 common investing strategies and give you the pros and cons for each. Now, I am of the belief that your system dictates your success. So you need to set a goal and then choose an investing system, an investing strategy, and that's what's going to define you as an investor, and that is what's going to help you to reach your goal. If you don't have a strategy, you won't have success. That's just my personal view on it. Now, there are dozens and dozens of investing strategies out there, and things can get a little complex. But what I am going to do is go over 3 common ones. One I believe in the most, which I don't think that's going to shock anybody here. But also, again, give you the pros and the cons for each one of these and help you to decide what may be best for you, because they all have some pretty good advantages to them, and then obviously some disadvantages as well. All right, so let's start with the first one here, and that is lump sum investing. That is very, very simple. Essentially, you take a lump sum, let's just say $10,000, and you invest it one time. That's it. That's lump sum investing. And the pro is, if you happen to drop that whole $10,000 in at one time and it happens to be the right time, you are in a really good spot because you bought at what you hope to be the bottom. Everything takes off from there. For example, let's say you had $10,000 back in 98 when Amazon went public. Let's say you had $10,000, I don't know, in 2015 when you first heard about Bitcoin and you held it since then. You'd be quite wealthy, even though Bitcoin is down as of this recording. But the opposite is also true. Let's say you took everything and put it in Nvidia this year or Netflix this year. Yikes, right? That's not what you want to do. So there are huge risks and rewards. However, data and studies have shown us that lump sum investing actually makes the most money out of each of these 3 approaches, including dollar cost averaging, which we'll talk about next. But again, you have to be right more often. Well, actually, you have to be right. It's not even right more often than not because it's only a one-time thing. So you have to be right, and that is it's high risk, high reward here. If you get it on the right time, or on the right day, at the right price, you hold for the long term, you are not going to catch up. Anybody else doing any other strategy is not going to catch up. The problem is, did you choose the right investment? Did you choose it on the right day? Did you get it at the right price? That's a big question mark, right? So it makes it more difficult to do, but, well, actually, it's easy to execute. We can all put every dollar we have or a large sum of money in one investment. So execution is easy, but to choose the right spot to get it at and over the long term is more difficult to do. And the risk is very, very high because obviously this year is an example. If you put all your chips on the table and put all your money early into the stock market, you got the worst price possible, right? And you lost a lot of money. So risk and reward here for lump sum investing is not fun, but studies have shown you actually make a little bit more money than dollar cost averaging, which we'll talk about next. Dollar cost averaging, which is basically known as DCA, is choosing to put in the exact same amount every single time. So I focused on every single time because it depends. It could be weekly, which is what I do on Public. I do that more to teach people about dollar cost averaging. You can do it bi-weekly, maybe you get paid, or on those days, 1st and 15th, every 2 weeks, whatever that may be for you, or you can do it monthly. The key here is every time you're investing, you're putting in the exact same dollar amount. So for example here, you could say that I'm just going to put in $1,000 every single time, no matter what the stock market is doing, which again is what you mostly see me do on Fridays. Now, I'm going to do a part 2 to this video and give you the secret sauce as to how I dollar cost average is just slightly different. However, I'm investing on a weekly basis every single time, regardless of what the stock market is doing. And dollar cost averaging says that it doesn't matter. If the market happens to be down, you're actually buying more shares because they're cheaper, right, when it's down, and then you're buying less shares when the market is up. So you are still doing a best practice, and it is by default on time. You're going to be right more often than not. You take out the risk of timing, whereas I have to be right if I am a lump sum investor. I don't necessarily have to be right if I am someone who is dollar cost averaging. So this tends to be a bit better. Do you make as much money as a perfect lump sum investor? No. Could you make more money than a lump sum investor who didn't pick the right time? Yes, you could be. So it really depends on when that lump sum investor decided to put the money in. Now, the disadvantage of dollar cost averaging. Number one, assuming, because assumptions matter in finance, assuming that I have the $10,000 and I'm breaking it out over, let's say, 10 months, well, month one, I invest $1,000, I have $9,000 sitting here doing nothing. That money is not growing. That is a disadvantage. Is it the biggest disadvantage in the world? It really depends on how much money we're talking, right? If I got $1 million sitting doing nothing for a year as I'm slowly investing $1,000 a month, then yes, right? But if I am, splitting it out with larger amounts, that's going to change things. But also, what if I don't have $10,000 to begin with, and I'm using this money from my earnings? So if I only get paid on Fridays, and I'm taking the money I have on that Friday and investing it, then it's different. And I wouldn't compare myself to a lump sum investor because I don't have the lump sum to compare with, right? So you always want to make sure that you are comparing apples to apples. Now, the disadvantage here is, number one, if you have a lump sum, then you have money that's uninvested during that time. That's a big if. Not everybody does. Number two here is that you could have chosen the most perfect time to invest, which again is really difficult, but it's technically a disadvantage. So that's really it for dollar cost averaging. My thing is it is right in the middle, and I think that's my investing approach. I'm not trying to get the hottest thing in the world. I also clearly don't want to get the worst thing in the world. Give me something that's solid, dependable, and reliable, and I think that's what dollar cost averaging does for the vast majority of people. It takes out the guesswork and takes out the timing risk when you sit down and say, look, I'm putting in whatever amount it is, $50, $100, $10,000. It is a consistent amount, and that's what's going to help you to build your wealth. The last thing I'll say about dollar cost averaging too is that this is where the majority of millionaires are made. Whether you say it's from your primary home, if you believe your primary home is investment, I don't, but if you do, that is in a sense that is dollar cost average, because you're paying a specific amount every single time. But in the stock market, there are a lot of 401k millionaires, or at least there were in 2021. Clearly, unfortunately, that number has dipped since the market has been down so far this year. But 401ks are essentially dollar cost average, because you're taking 10%, 15%, 25% of your salary and putting it in whenever you get paid. So it does work. All right, so last one I want to discuss here is value averaging. Now, I want you to shift your approach, because this is going to be a bit different. So dollar cost averaging, we were saying I'm focused on what I'm putting in. I don't really care where the market is. I don't care what my portfolio value is. I am putting in what I'm putting in every single month, and whatever I got is what I got. Value averaging is different, where it focuses on the portfolio value. How much do I have, and where should I be? So that's what we're comparing it to when we talk about value averaging. So take a look at this. So what I'm doing in value averaging is I'm going to sit here and focus and set a goal. So my goal, and these are examples here, my goal is to have, let's start off with June, then we do July, August, and September. Okay, my goal here is to have 10,000. Let me write that a little bit better. My goal is to have 10,000 in June. I want 11,000 in August, 12,000. I'm sorry, 11,000 in July, 12,000 in August, and then I want 13,000 in September. Okay. Now, the other thing is the reality, or I'll put actual. So this is where I want. That doesn't mean it actually happened, right? So I want my portfolio value end of June 10,000, end of July 11,000. I want my portfolio to be at these amounts at the end of that time frame. But in reality, what if end of June I have 9,000? Okay, so in this example, that means I would need to add $1,000. Actually, no, I would actually have to add $2,000 to my account. Why am I adding 2,000? Well, if the market dips down, I'm at 9. I need to add 2,000 to get to 11,000 now. So I'm really saying, where's my account at? Where should it be based on my personal schedule? Well, now let's say that you're at 11,000, right? You've added 9 and 2 together, and then you hit July, and now the market took off. And you're like, great, this is awesome. And at the end of July, your portfolio value now is at 15,000. That sounds good. My goal though is to be at 12,000 in August. So that means I now need to subtract and take out $3,000. Okay? So now I'm really buying low and selling high, which is in some ways how this is. So the market went low, I bought in. I put in $2,000. I got to my goal for 11. Then the market went up, right? I got to $15,000, but I was really supposed to be at 12, so I sold. So I bought low, added 2,000, I sold high, and sold $3,000. So I'm right back at $12,000. Market falls again. Let's say that we are down to 9,000 this time. Okay, now I'm behind, right? I'm at 9,000. I need 13. So this time I have to add $4,000. That gets me at 13. And let's say this time the market falls more, and now I'm at 10. Okay, and then in this case, I would need to add, I guess, $4,000, because if this is going to continue to increase. So in October, you're supposed to have 14. So in this case, I would add another $4,000. Now, here's the thing. On paper, this sounds great. Buy low and sell high. The issue is in practice, there are, I would say, 2 big risks that immediately come out. The first one is, if you start to fall behind, this, number one, assumes that you have the money to catch up. So for example, if we go back here, this assumes that you had an additional $8,000 in those past 2 months. That is a big assumption, right? And you can do it with hundreds of dollars or just $40 or what have you. So number one, it assumes that you had that money. If you fall behind, these gaps get a lot bigger because your goal on the left-hand side is only going to increase. It does not go down. So that means that you had to have the money on the side, which also means that if you had this $8,000 sitting in your account, then this money was not growing this entire time, which means that your returns are probably a bit lower because you could have invested this $8,000, I don't know, in June, and that money could have grown, or you could have dollar cost average and been investing portions of that money throughout the entire year. That, you know, depends on what you invest in and all those types of things, but that's the thing here. The other part is, let's say in the case where the market was up and you sold to come back down to where you were. That depends. That's a $3,000 tax bill that I now have to pay, assuming this is not in one of your IRA accounts. Right? Now, could this be offset by some of the losses? Yeah, it could, but that's assuming that you sold. So in this case, you know, I could have kept that $3,000 and stayed at 15 and continued to invest on my regular schedule and save that money, or maybe even help me out. But the math does not always work out in the investor's favor here, even though on paper it sounds really good. Should you try it or would you try it? You do what you want. See if it fits for you. What I do like about value averaging is that it does set a very clear goal for where I want to be. If I want my portfolio to be at 10,000, I need to put whatever I need to get to that 10,000. And if it's not there, then I need to add more and more and more, which does, similar to dollar cost averaging, while it's not the same amount, it does help me to buy on a consistent basis. The only thing is, do I have enough money to catch up? In this case, if the market is down. So for even for my account, let's say that was this May now, if January was 10,000 and you keep going all the way through to June, you're looking at what, almost $16,000. Well, if the market's been falling, you're at 9. You have to add a whole lot of money now to get all the way back to the 16,000 that you should have been at. And again, the market keeps falling, and let's say the market falls all the way through to December, then you are really shoveling way more money than you probably have, and you end up out of money and you cannot invest. That would be the issue. That's the worst case scenario. The best case scenario is, let's say the market is rising. Well, let's say that, let's go back to the whiteboard here. let's say that in July the stock market takes off and you're basically selling and capping those gains. And while yes, you can say, look, I'm locking in these profits, and then I'm taking, it went up, I take my money off the table, I get to save myself from whatever may happen. While that is true, but that's still less money that's compounding over time. So if we are selling every time you hit a new milestone, then let's say over 5, 6, 7 years, that's less money you have compounding, and you're probably gonna have less money at the end of the day compared to the dollar cost averager or the person who put everything in at one time. So I like the logic behind value averaging. I don't like the math behind it. More importantly, I don't like the practicality behind it, because you can end up having a higher tax bill if it's not inside of an IRA. If the market is down, you may not have enough money to catch up to where you were supposed to be. But I do like the cleanliness of it. I do like opening my account and seeing a nice even balance. Obviously it's going to change throughout the year and the day, but I like the approach. I don't necessarily like it in practice. So those are my 3 analysis. Of the 3, obviously dollar cost average is like I said, I try to be right in the middle. I try to be even and go for what I know works and what can work consistently. I can't guarantee that lump sum investing is going to work consistently. Also, if you had a lump sum, it depends on what that sum is, right? Can a $1,000 one-time investment build incredible wealth for me forever and ever? Not unless it was Bitcoin, right? And this was like, decades ago, or Microsoft or whatever. So it's going to be hard. Most of us don't have a lump sum big enough to support us for, again, forever and ever. So that leaves us with dollar cost averaging that's right in the middle and doesn't get us into a trap where I'm behind and I have to throw in $4,000 a month. Dollar cost averaging is 100,000, whatever it is, 50. This is what I'm putting in on a consistent basis, regardless of where the market is, and usually puts you in the best places more often than not. All right, so that is my analysis on these 3 investing strategies. Let me know what you think in the comments. I want to be here to help you become a better investor. So what can I help you out with? Let me know in the comments below. Part 2 of this video will show you how I dollar cost average is going to put a little bit of a twist on it to hopefully boost my returns a bit more and kind of attack the market in a slightly different way. All right, that's it for me. I'll talk to you later. Bye.